June 2025. The cameras are rolling. The governor of Florida steps up to the podium, and within seconds you can see it. His jaw is clenched, his tie slightly askew, and there's something in his eyes that tells you this isn't going to be another polished political speech. Then he starts talking, and the room goes silent. This is not a drill. Florida families are being squeezed out of their homes, and I will not stand by while insurers and lenders pull the rug out from under them. His voice cracks with frustration as he slams a stack of foreclosure notices onto the podium. The sound echoes through the Roberto Alonso Community Center in Miami Lakes like a gunshot. Reporters lean forward. Homeowners in the back row start nodding, some fighting back tears. This is the moment when a sitting governor publicly admits that one of America's hottest real estate markets has become a nightmare. And nobody, not the insurance companies, not the lenders, not even the state itself, seems able to stop the bleeding. But here's what makes this story absolutely devastating. Just 4 years earlier, this same market was a gold rush. People were sleeping in cars outside leasing offices. Bidding wars raged past midnight. Cash offers flew in from buyers who had never even set foot in Florida. So what happened? How does a market go from everybody wants in to a governor losing his composure on live television while families lose their life savings? The answer isn't just one thing. It's a perfect storm, a chain reaction so brutal and so avoidable that when you hear the full story, you'll understand why the governor couldn't keep his cool. Because this isn't just about real estate. It's about retirees crying in boardrooms, teachers draining their savings to cover bills they never saw coming, and an entire generation of buyers being locked out of homeownership, not by the market, but by a system that broke down in spectacular fashion. Let me take you back to where this all started, because the beginning of the end looked like a dream come true. Picture this. It's spring 2021. The pandemic is still fresh in everyone's mind, but Florida is wide open. Restaurants packed, beaches buzzing, and the "Welcome to Florida" signs might as well have flashing lights because people are flooding in like never before. We're not talking about a few thousand snowbirds. We're talking about more than 220,000 new residents in a single year. That's the equivalent of adding a city the size of Boise, Idaho, directly into Florida's housing market. Palm Beach County alone gained over 16,000 residents. Miami-Dade and Broward. Lines out the door. U-Haul trucks became so scarce that rental prices tripled. Highways jammed up. Schools added portable classrooms just to handle the influx of kids. And who were these people? Remote tech workers escaping California taxes, families fleeing cold winters and lockdown restrictions, retirees accelerating their plans, international buyers from Latin America seeing opportunity, investors smelling blood in the water. Everyone wanted a piece of Florida, and they wanted it now. Census data and USPS change of address forms painted the same picture. Florida ranked first in net domestic migration, outpacing Texas, Arizona, and the Carolinas combined. Demographic analysts couldn't believe the numbers. Utility companies reported record hookups. Some neighborhoods in Port St. Lucie and Cape Coral saw their fastest population growth in over 3 decades. Miami's skyline. It looked like a forest of construction cranes trying desperately to keep up with demand. But here's the problem. Inventory couldn't keep pace. By late 2021, the number of available condos for sale in Miami-Dade, Broward, and Palm Beach hit a 15-year low. You read that right. The lowest supply in over a decade, while demand was at an all-time high. It was the perfect recipe for chaos. And chaos is exactly what happened next. Imagine you're a realtor in Broward County. It's a muggy Saturday morning in July 2021. And you're about to unlock the door to a modest 2-bedroom condo priced just under $300,000. You've barely propped open the blinds when you hear footsteps. 3 couples arrive within minutes, all waving pre-approval letters. 2 have cash. You glance at your phone. It's only 9:30 in the morning and you already have 16 text messages from other agents begging to schedule showings. By noon, the parking lot looks like a concert venue. One family from New Jersey toured the unit for less than 5 minutes, then offers $20,000 over asking. They haven't even seen it in person. Their out-of-state parents wired the deposit sight unseen. A local couple, both school teachers, try desperately to match the bid, but they lose when a Miami investor submits a cash offer and closes the deal before lunch. By 3 p.m., the condo is under contract, and you're fielding backup offers just in case the first deal falls through. This wasn't a one-time event. This was every weekend, every listing. In Hallandale Beach, a one-bedroom condo listed at 9 a.m. for $289,000 had 16 offers by 2 p.m., 10 of them cash. In West Palm, agents started joking that open houses needed velvet ropes. Some desperate buyers submitted family photos, handwritten letters, even homemade cookies, hoping to sway sellers. But sentimentality doesn't beat cash, and charm doesn't beat speed. Realtors described it like a lottery where the odds got worse every single week. Units under $300,000 lasted less than a day. Buyers camped outside leasing offices. They set alarms for midnight to scan new listings the second they went live. They called in favors with mortgage brokers, pulled strings, begged family members for down payment help. And still, most of them walked away empty-handed. Behind every closed sale was a crowd of frustrated families watching affordability slip further and further out of reach. The market wasn't just hot, it was on fire. And everyone, buyers, sellers, investors, agents, believed the flames would keep burning forever. But then June 24, 2021 happened, and everything changed. It was early in the morning when Champlain Towers South, a 12-story beachfront condo in Surfside, collapsed without warning. 98 people lost their lives. Families were buried under concrete and steel while rescuers worked around the clock in the rubble. The images were everywhere. News helicopters circling, dust clouds rising, survivors recounting how they heard a sound like thunder before half the building came down. The tragedy sent shockwaves far beyond Surfside. Suddenly, every condo owner in Florida was asking the same terrifying question: could my building be next? Engineers and inspectors were called in. Structural assessments became front-page news, and what they found was chilling. Decades of deferred maintenance, crumbling concrete, water intrusion, corroded rebar. Buildings that looked fine on the outside were rotting from within. Florida's lawmakers knew they had to act, and fast. Within a year, the state legislature drafted and passed Senate Bill 4D, one of the most sweeping condo reform laws in U.S. history. On paper, the intent was noble: prevent another Surfside, ensure safety, protect lives. But in practice, it became the spark that ignited a financial catastrophe. Here's what the law required. Every condo building over 3 stories must undergo a structural milestone inspection by the time it hits 30 years old, and then every 10 years after that. For buildings in Miami-Dade and Broward, the rules were even stricter. Inspections had to be completed by the end of 2024, regardless of the building's age. Suddenly, engineers were booked out for months. Inspection reports started rolling in, thick binders filled with urgent red flags. Spalling concrete, foundation issues, failing waterproofing, electrical hazards. Repairs that had been put off for years, sometimes decades, were now mandatory. But the law didn't stop there. It also required condo associations to build up reserve funds. For years, many buildings had operated with minimal reserves, sometimes none at all. Boards kept monthly HOA fees low by deferring expensive repairs, kicking the can down the road. That strategy was now illegal. Every association had to commission a reserve study and start collecting enough money from owners to cover future needs. And when those numbers came back, families opened their mailboxes to find bills that looked like ransom notes. The median special assessment landed at $45,000 per unit. $45,000. For some buildings, especially older ones with serious structural issues, the number climbed into six figures. Owners who had bought condos expecting stable, predictable fees suddenly faced bills that rivaled an entire year's salary. In Fort Lauderdale, the board at Sunrise Towers held an emergency meeting after their inspection uncovered spalling concrete and water intrusion on multiple floors. The required repairs, $6 million. The board, made up of retirees and working professionals, sat around a conference table trying to figure out how to break the news to their neighbors. One board member would later describe the mood as grim, like telling people they'd won the world's worst lottery. The options were stark and brutal: pay up, sell at a loss, or risk the building falling out of compliance and losing insurance altogether. Some associations couldn't even find qualified inspectors in time, risking fines and legal action from the state. Real estate deals started falling apart mid-closing, as buyers read disclosure packets detailing upcoming assessments and backed out on the spot. State lawmakers defended the reforms, pointing to Surfside and arguing that safety could no longer be optional. Public hearings included emotional testimony from engineers, insurance executives, and grieving families. But for condo owners, the intent didn't matter. The economic shock was real and immediate. For every building that passed inspection and successfully funded reserves, there were dozens more staring down repair bills they simply couldn't afford. The law had tied safety and solvency together in a way the market had never experienced before, and the financial pressure was about to come crashing down on everyday Floridians. By mid-2025, the true cost of these new laws hit home, literally. Monthly HOA dues, once a manageable budget line, exploded almost overnight. The average fee for a two-bedroom condo in Broward or Palm Beach topped $1,250 a month, up more than 50% from just 3 years earlier. In older buildings, the pain was even worse. Owners weren't just dealing with higher monthly dues, they were slammed with special assessments that arrived in waves, each one more urgent than the last. Letters from condo boards landed in mailboxes with the frequency of junk mail, except these weren't advertisements. They were financial ultimatums. Some demanded $45,000 or more per unit to cover emergency repairs and replenish depleted reserves. For retirees on fixed incomes, the news hit like a truck. At Seabreeze Residences, a 1970s-era building in Miami, the board proposed a 300% hike in monthly fees. 300%. The meeting room filled with anxious voices, neighbors who had lived side by side for decades now united in panic. One retired schoolteacher clutched her notice, her hands shaking, and whispered through tears, "This will bankrupt us." Several residents walked out before the vote even happened, already doing the math on how much they'd lose if forced to sell into a crashing market. These stories weren't isolated incidents. They were everywhere. In Fort Lauderdale, a widow who bought her condo for $180,000 back in 2016 watched her monthly obligation climb from $600 to nearly $1,700. Her pension barely kept pace, and the threat of yet another special assessment loomed over every board meeting. In West Palm Beach, a couple in their 70s drained their entire savings account to cover a $52,000 assessment, only to learn weeks later that their HOA was planning another increase to cover insurance shortfalls. Analysts from the Federal Reserve Bank of Atlanta issued warnings that these costs weren't a temporary spike. They were the new normal. Owners who had counted on stable, predictable expenses now faced a moving target, with fees and assessments rising faster than Social Security checks or investment returns. Economists started calling it an affordability crisis, but for the people living through it, it was a question of survival. Do we pay this bill, or do we eat? Do we stay in the home we've lived in for 20 years, or do we walk away and lose everything? The emotional toll showed up everywhere. in boardrooms where neighbors shouted at each other, in hallways where "for sale" signs multiplied like weeds, at kitchen tables where families wept over spreadsheets that didn't add up. Investors who once snatched up Florida condos without a second thought began pulling back. Even those with deep pockets hesitated at the prospect of runaway fees and unpredictable liabilities. First-time buyers and middle-class families, they were priced out before they could even make an offer. The practical result was a market full of listings, but fewer and fewer people able or willing to shoulder the risk. Owners were trapped, unable to sell without taking massive losses, unable to stay without going bankrupt. And just when it seemed like things couldn't get worse, the insurance industry delivered the knockout punch. Between 2022 and 2025, 6 major insurance carriers either failed or withdrew from Florida entirely. United Property and Casualty, once a cornerstone for coastal condos, cut more than 30,000 policies in August 2025 alone, right as hurricane season reached its peak. St. John's, FedNat, and others followed, each announcing their exit with barely any warning. By the time the dust settled, more than 600,000 homeowners statewide had lost their private coverage in less than 3 years. The reasons were spelled out in filings with the Florida Office of Insurance Regulation. Escalating reinsurance costs, mounting litigation, and catastrophic exposure made the business model unworkable. For South Florida, the impact was immediate and devastating. Buildings that had renewed policies without issue for decades suddenly found themselves blacklisted by every major underwriter. Boards faced impossible choices: pay triple the premium for a bare-bones specialty policy, risk going completely uninsured, or force yet another special assessment on residents who were already stretched to the breaking point. And here's where it gets even worse. Lenders began rejecting mortgages on units in buildings without compliant insurance. Deals that were already in escrow, with earnest money deposited and moving trucks reserved, collapsed overnight. Sellers had no way out. Buyers had no way in. The insurance exodus didn't just raise costs, it introduced a terrifying new uncertainty. Would your building even qualify for coverage next year? Or would the next hurricane forecast send another carrier running for the exits, leaving you high and dry? For thousands of condo owners, the answer came in the form of cancellation letters, and a market that was suddenly very short on options but very long on risk. With private insurers fleeing, Florida homeowners had nowhere left to turn except Citizens Property Insurance, the state-run insurer of last resort. By the end of summer 2025, Citizens was carrying more than 1.1 million active policies, double what it had just 18 months earlier. That growth wasn't a sign of success. It was a flashing red warning light that the private market had completely collapsed. In South Florida, entire condo buildings landed on Citizens' rolls after receiving non-renewal notices from every private insurer that was still willing to write coastal risk. Boards scrambled to secure even the most basic coverage, often settling for stripped-down policies with sky-high deductibles and limited protection. And here's the kicker. For buyers, Citizens coverage became a deal-breaker. Major lenders, Wells Fargo, Chase, United Wholesale Mortgage, all issued new guidelines in 2025. If a condo was insured only by Citizens, loans would face extra scrutiny, higher down payments, and in many cases, outright rejection. Fannie Mae and Freddie Mac, the two giants that back most American mortgages, now required proof of supplemental coverage for wind, flood, and full replacement cost. If a building Citizens policy left any gaps, and most did, the loan was ineligible. Deals that had made it all the way to the closing table unraveled in minutes as underwriters flagged associations with incomplete or insufficient insurance. Some buyers lost their deposits. Others watched their interest rates spike as their only remaining option became a riskier portfolio loan with worse terms. Loan officers across Miami-Dade and Broward described a painful new routine, explaining to frustrated, sometimes tearful clients that even a pre-approval letter meant absolutely nothing if the building's insurance didn't pass muster. One veteran mortgage broker in Fort Lauderdale put it bluntly, "It's not about your credit score anymore. It's about your building's insurance binder." In buildings with recent structural assessments or a history of deferred maintenance, the list of willing lenders shrank to almost zero. Cash buyers suddenly had all the leverage, but even they hesitated when they saw shaky insurance coverage or the threat of another premium hike looming on the horizon. The result? A market where listings sat and sat and sat, not because there wasn't interest, but because financing had become an absolute minefield. For first-time buyers and working families, the dream of owning a South Florida condo didn't just fade, it vanished behind a wall of red tape, rising costs, and lender refusals. The safety net that was supposed to catch people was now stretched so thin it threatened to snap, leaving both buyers and sellers searching desperately for a way out that simply didn't exist. Before we go any further, if you're finding this story as jaw-dropping as I did when I first dug into it, do me a huge favor. Hit that subscribe button right now so we can reach 10,000 subscribers. Seriously, we're on a mission to bring you the most in-depth, no-nonsense breakdowns of the stories that actually matter, the ones that affect real people and real money. And drop a comment below. I want to know. Would you still buy a condo in Florida in 2025? Or has this crisis completely changed your mind about real estate in the Sunshine State? Let's talk about it. Your insights might just help someone else make a smarter decision. All right, let's get back to the disaster. By mid-2025, the mortgage math in South Florida had turned absolutely punishing. The median monthly cost to own a condo, and we're talking principal, interest, HOA dues, insurance, and those dreaded special assessments, easily topped $2,100 a month. For thousands of buyers, the sticker shock didn't end at the purchase price. HOA fees alone could swallow half of someone's paycheck. Special assessments, which used to be rare emergencies, now arrived with disturbing regularity, sometimes tacking on hundreds or even thousands more each month. Owners who had budgeted for a $1,400 payment back in 2021 were now shelling out nearly double, with little warning and absolutely no recourse. The numbers don't lie, and they're relentless. In Broward and Palm Beach counties, it became common to see monthly obligations for a modest two-bedroom condo climb from $900 to $1,700 in just 3 years. In older buildings, especially those hit hardest by inspection requirements and insurance hikes, the burden was even heavier. One West Palm Beach resident who bought her unit for $180,000 in 2016 now pays almost $1,700 a month, nearly triple her original payment. And her story, it's not an outlier. It's the new normal. Across the region, retirees on fixed incomes, teachers, young families, everyone is struggling to keep pace with bills that outstrip their wages, their savings, and their hope. This isn't just anecdotal pain. The Federal Reserve Bank of Atlanta's mid-2025 report confirmed that median condo payments in South Florida have crossed the $2,100 threshold. And here's the cruel irony. Even as prices for many units have fallen, the culprit isn't the mortgage, it's everything else. Insurance. Premiums have doubled, sometimes tripled. Board-imposed reserve contributions and emergency repairs have pushed monthly dues to record highs. For buyers relying on FHA loans, which are designed to help first-time and lower-income buyers, the situation is even grimmer. FHA condo approvals have dropped by roughly 40% since last year as more and more buildings fail to meet updated reserve and inspection standards. That means fewer affordable financing options and more rejections at the closing table, sometimes at the last possible minute. The fallout has landed hardest on the people who can least afford it: working families, teachers, nurses, small business owners, first-time buyers. Mortgage application volume for Florida condos has plummeted, down nearly 35% year over year. Lenders, now hyper-aware of ballooning monthly obligations and shaky association finances, are demanding higher down payments, pristine credit scores, and detailed documentation that many buyers simply can't provide. The result is a market where the cost to carry a condo has become a barrier that fewer and fewer people can clear, even as home prices slide and listings pile up week after week. For many Floridians, the dream of homeownership in the Sunshine State has given way to a monthly bill they can't escape and fewer ways to manage it. And it gets worse. By the summer of 2025, the rules for borrowing had changed almost overnight. Loan officers who were once flooded with eager, pre-approved applicants now spent their days explaining why those pre-approvals no longer guaranteed a closing. Banks weren't just looking at credit scores or pay stubs anymore. Every single file was dissected for risk. They wanted to see the building's insurance binder, the reserve study, pending special assessments, inspection reports, everything. If a condo association relied on citizens' property insurance alone, lenders demanded 30% down, sometimes more, or they declined the loan outright, no negotiation. Fannie Mae and Freddie Mac required airtight proof of full replacement coverage and strict compliance with the new reserve rules. Any gap, any missing document, any red flag, and the loan was dead on arrival. Interest rates above 7% became the new normal, and many buyers were quoted even higher if their building showed any sign of financial stress. A two-bedroom unit that might have required $60,000 down in 2022 now demanded $100,000 or more just to get started. For first-time buyers and middle-class families, the math simply didn't work. You couldn't save fast enough. You couldn't earn enough. The goalposts kept moving further and further away. Mortgage application volume for condos in Florida dropped 35% year-over-year, and some lenders quietly pulled out of the market altogether, citing too much volatility and too little reward. Loan officers in Miami-Dade and Broward described a shift from rubber-stamping approvals to redlining entire buildings. One veteran broker summed it up perfectly. "We used to compete for buyers. Now we compete to avoid risk." Underwriting teams started flagging buildings with unfunded reserves, deferred maintenance, or recent insurance claims. Even buyers with perfect credit, stable jobs, and significant savings found themselves sidelined by stricter debt-to-income ratios and endless documentation hurdles. The result was a shrinking pool of qualified borrowers and a growing mountain of unsold listings. Cash buyers and investors picked through the remains, but even they hesitated when faced with runaway fees and the constant threat of another massive assessment. For everyone else, the message was painfully clear. Unless you could put 20% down, clear every single hurdle, and absorb a payment north of $2,100 a month, the door to South Florida's condo market was closing fast, and it was slamming shut on an entire generation of would-be homeowners. And then there's Deltona. If you've never heard of Deltona, Florida, you're not alone. It's a quiet city tucked between Orlando and Daytona Beach, not a glamorous beach town, not a luxury destination, just a middle-class community where people bought condos expecting stability and a modest return on investment. But by the summer of 2025, Deltona became ground zero for Florida's condo crash. The numbers are absolutely brutal. Median condo prices in Deltona dropped more than 32% year-over-year, wiping out hundreds of millions of dollars in homeowner equity in less than 12 months. Units that were selling for $250,000 in early 2022 now struggle to attract offers above $150,000. The local MLS shows a 14-month supply of condos on the market. To put that in perspective, 5 months of inventory is considered a balanced market. 14 months means sellers outnumber buyers by a massive, unsustainable margin. For long-time residents, the collapse is more than just numbers on a spreadsheet. At the Oak Ridge Villas complex, A group of desperate owners gathered signatures for a petition demanding relief from city officials after their monthly HOA dues doubled, and special assessments landed like a second mortgage they never agreed to. Some retirees, blindsided by five-figure repair bills, now spend their mornings on the phone with foreclosure hotlines or sitting in bankruptcy attorneys' offices trying to figure out if there's any way to salvage what's left. The community Facebook page, once filled with block party invites and recommendations for local plumbers, is now a running tally of units in default and neighbors being forced to walk away from homes they thought they'd own for life. Foreclosure filings in Volusia County, where Deltona is located, have jumped 41% since January, and Deltona accounts for the largest share of those filings. Local legal aid clinics report a surge in desperate calls from condo owners, teachers, nurses, small business owners, people who can no longer keep up with ballooning fees and plummeting home values. Real estate analysts have warned that the city's inventory glut is unlikely to clear anytime soon, and with every month that units linger unsold, prices sink further, pulling more and more owners underwater and tempting investors to circle like vultures looking for bargain buys. The ripple effects stretch far beyond Deltona's city limits. Lenders in North Carolina and Texas are now scrutinizing condo associations for reserve funding and insurance coverage, terrified of importing Florida's crisis into their own markets. State housing officials in Arizona have cited Deltona's collapse in committee hearings, using its 32% price drop as a cautionary tale for their own aging condo stock. But for Deltona's homeowners, the national headlines and policy debates mean nothing. For them, the pain is immediate and personal, a daily reckoning with bills they can't pay, equity they've lost, and a market that no longer offers an easy exit or any exit at all. The ground zero of Florida's condo collapse isn't a beachfront luxury tower filled with foreign investors. It's a middle-class city where everyday people played by the rules, bought homes they could afford, and watched the promise of stable homeownership turn into a slow-motion financial emergency. And that brings us back to June 2025, and the moment when Florida's governor finally reached his breaking point. The scene at the Roberto Alonso Community Center in Miami Lakes was tense before the governor even walked in. Reporters clutched foreclosure statistics. Homeowners waved crumpled HOA bills in the air. A row of staffers exchanged clipped, nervous text messages, unsure of how this was going to go. Then the governor stepped to the microphone, tie slightly askew, jaw clenched, and the room went silent. "This is not a drill," he began, his voice already tight with frustration. "Florida families are being squeezed out of their homes, and I will not stand by while insurers and lenders pull the rug out from under them." He pointed directly at the insurance companies that had abandoned the state. United Property, St. John's, FedNat, all gone in less than 3 years, leaving more than 600,000 homeowners statewide without private coverage. His tone grew sharper, angrier. "Let me be clear. If you're an insurance company that wants to take Floridians' money for years and then vanish when the market gets tough, you're not welcome here. We are done playing by your rules." Then he slammed a stack of foreclosure notices onto the podium. The sound cracked through the room like a whip. He rattled off the statistics, his voice rising with each one. Deltona's median condo price down 32%, a 41% jump in foreclosure filings across Volusia County, HOA dues that now rival a second mortgage for thousands of families. "We have retirees getting eviction notices because of insurance games and runaway assessments," he said, his frustration boiling over. "Working families are being told their dream of homeownership is over because Wall Street and out-of-state carriers can't stomach a little risk. That's not the Florida I represent." Questions flew from the press gallery. What about the failed reforms? What about citizens' ballooning policy count? What about the mass exodus of private insurers? The governor's frustration was palpable, his answers clipped and defensive. Citizens was never meant to be the only option for 1 million Florida homes, he shot back. We're supposed to have a functioning market, not a single safety net stretched to the breaking point. He called out the blame game that had been playing out for months between lenders, insurers, and condo boards, warning that finger-pointing wouldn't solve anything. We need real solutions now. Not next year, not after another special session. If the legislature can't deliver, I will use every executive power at my disposal to protect Floridians. Then came the direct challenge, the moment that would dominate headlines for weeks. To the insurance executives watching, if you're planning more cancellations, you'd better be ready to explain it to every family losing their home. And to the lenders, don't think you can hide behind paperwork while communities fall apart. He ended with a clipped, defiant promise. We will not allow Florida's condo market to collapse on the backs of its people, not on my watch. The press conference ended abruptly, but the impact lingered. The governor's anger, raw and unscripted, captured something deeper than political theater. It was the voice of a state watching its middle class crumble in real time, the anxiety of buyers locked out of the market, the desperation of owners trapped in homes they could no longer afford, and the political peril of a crisis with no easy fix and no clear villain to blame. So here's where we stand in 2025. Deltona's condo prices have cratered by 32%. Unsold inventory has hit a 14-month supply, the steepest, most dramatic decline recorded in Florida's recent history. What started as a dream, a migration wave that pushed demand and prices to all-time highs, turned into a nightmare fueled by stricter safety laws, soaring association fees, and the catastrophic exit of 6 major insurance carriers. By mid-2025, Citizens Property Insurance was carrying over 1.1 million policies, more than double its load from just 18 months earlier. FHA condo loan approvals fell 40%. Mortgage applications for condos dropped by 35%. Tens of thousands of owners found themselves trapped, unable to sell without catastrophic losses, unable to stay without going bankrupt. Despite the governor's public outburst, despite emergency meetings and political promises, the questions remain unanswered. Will further regulatory changes restore buyer confidence? Can insurance access and affordability ever be rebuilt in a state this exposed to climate risk? Can aging buildings be brought up to code without financially destroying the people who live in them? As of today, right now, thousands of Florida condo owners and would-be buyers are still facing rising costs, shrinking options, and a future that feels more uncertain with every passing month. The collapse of the South Florida condo market stands as a documented, undeniable warning. It's clear evidence that financial pressures, regulatory shockwaves, and political failures can converge to reshape entire communities, destroy generational wealth, and lock out the very people who built the dream in the first place. And the scariest part, the effects are still unfolding. This story isn't over, not even close.